Hi, Mike Swanson here. We're going to do a pre-market update on the financial markets. This morning we're having a little bit of a gap up. The S&P's up 6 points. But more importantly is what's taken place in the past couple of weeks. We have seen some quick intraday moves up that then faded, and the market just would dump the next day. This happened last week, and it just happened a few days ago. If you recall, there was a bit of excitement. I think it was on Tuesday that Warren Buffett had made an investment in Apple. Well, you know, he did the same thing in IBM a couple years ago, and IBM's been a horrible stock. Apple's been lagging the stock market for quite some time. It's not going to change that situation, but it caused a lot of excitement on CNBC. The market went up, and then it dumped the next day. And then on Wednesday, Fed minutes came out that that said that some of the Fed minutes were from April, and it showed that at the last meeting, a couple of the Federal Reserve officials really wanted to raise rates as quickly as they can. They're worried that they're losing their credibility because back in December they predicted 4 rate increases, and we haven't seen one yet. And that was really the news item of the day. But the market fell. And that caused people to wring their hands and kind of worry. But then yesterday, things were weak in the morning, and there was a little bit of a rally. Even though the S&P fell, closed down 7 points, 7.59, it did bounce off of an intraday low. The low is 2025, so a lot of the losses in that morning were taken back. Now, what's important is to figure out what does that mean? How do we draw meaning for that? Way too often people grasp on these news stories and try to figure out what's going on. In reality, the stock market right now is trading much like it did last fall after we had a massive rally in October. It spent 3 months, or really 2 months, basically making a top and then dumped. And in the summer, something similar happened too. After May, the market really spent 2 months making a top and then dumped in August. I think we're in the same sort of situation. The internals of the market are once again starting to go down. That means more stocks are actually acting weaker than acting strong. But we're also getting a similar type of buying pattern when the market does go up that we saw in those last 2 time periods. And that's buying not fueled by individual investors. The statistics actually show that more money is now coming out of the stock market from small investors and going into it, and even from foreign investors, and even from large institutional investors, and even from insiders. But yet, there is buying that does come in from time to time to help pop the market back up. Where does that buying come from? Primarily, I think, from trading robots. We do know that was the case in August and July, because the statistics show that more volume or more trades were being done by trading robots, computer programs, than real people. And those type of programs typically look for technical support levels. They do day trading or minute trading, you could even say. And 2020 is a support level now for the market. It's where the point of the 150-day moving average is. So once the market kind of started to hold that level yesterday in the S&P 500, I think it's pretty logical to assume that trading robots then kicked in. The question is, how much higher can they take the market? Well, we're gapping up today, but I've never seen trading robots create a bull market. They were unable to break the market out last year to new highs and do anything. They didn't, the rally in the fall failed. I think this rally's topped out. So trading robots are just day trading. They flip in and out, and they can turn off. And that's basically what happened at the end of August and in January. So I do think, we're seeing, I interpret today's gap up as follow through from yesterday's intraday rally off the lows. I don't expect it to really delete anything big. Maybe the market can go up today, maybe for a day or 2 or 3 days. There's really no way to predict short-term moves of that sense. What's more important is to put the short-term moves into a broader context. The broader context is a topping formation that will lead to losses down the road in weeks and months to come. But for today, the market can go up. It can go up for a couple days. And that is going to be what is grasped onto. If the market's up today, turn on CNBC and watch Fast Money. They're all going to start to get excited again. You'll probably even hear people talk about buying Apple or Facebook or something like that. But you've got to always put these moves in the big context and ignore these kind of news stories. What the news story this week now, it was Apple, but now it's Fed rate hikes. Well, they're not going to raise rates. On my Facebook page, I showed that for years, Steve Leisman of CNBC has been predicting these Fed rate hikes. They never happen. Here's him talking about this in 2012, and it didn't happen back then. If you recall, that's when you had the little summer flash crash, and then QE had to be done. So that's where we are. And then we're also, with the gold market, seeing a new bull market this year, but we've had a pullback off the highs. And I did a detailed article about this on my website. Go to wallstreetwindow.com, and you can read it. My views on gold. I also reviewed Jordan Roy Byrne about gold. And I might line up a live interview with David Scarica today after the close. I'm going to have to talk to him, see if he's available. If so, go to Wall Street Window after the close today for that live interview, and we'll analyze the market this week and what we think things are going and how to profit from all this madness that you've been seeing. So that's a quick pre-morning update. Talk to you later.